The Minority Market. Episode 24. How Business Cycles Affect Companies. Most beginners look at company performance in isolation. They see revenue growth, profit numbers, or stock price movement, and assume these trends will continue forever. What they fail to understand is that every business operates inside a larger economic and industry cycle. These cycles quietly shape demand, costs, profitability, and investor sentiment. If you ignore business cycles, you will often enter at the wrong time and exit emotionally. Understanding cycles is not about predicting the future perfectly. It is about building awareness of the environment in which companies operate. Every economy moves in phases. Expansion, peak, slowdown, recession, and recovery repeat again and again. During expansion, businesses grow faster, consumers spend more, and optimism rises. During slowdowns or recessions, demand falls, costs rise relative to revenue, and fear dominates. These phases directly affect company performance. A strong company can struggle during a downturn, and a weak company can temporarily look impressive during a boom. The minority learns to separate business quality from cycle-driven performance. Imagine a farmer. Even if he uses the best seeds and techniques, he still depends on seasons. Rainfall, temperature, and soil conditions affect output. Similarly, companies operate within economic seasons. Interest rates, inflation, consumer confidence, and government policies act like weather conditions for businesses. The majority reacts emotionally to short-term results. The minority observes the environment and adjusts expectations accordingly. One common mistake beginners make is extrapolation. When a company shows strong growth for a few quarters, people assume that growth will continue indefinitely. They buy at high prices, expecting permanent success. When the cycle turns and growth slows, panic selling begins. The minority avoids this trap by asking a simple question. Is this growth driven by long-term structural advantage or temporary cycle-driven demand? This question alone can protect you from many costly mistakes. Different industries respond differently to cycles. Some sectors are cyclical, such as automobiles, metals, construction, and real estate. Their performance rises sharply during economic booms and falls heavily during slowdowns. Other sectors are more defensive, such as healthcare, consumer staples, and utilities. These businesses tend to remain stable even during downturns because people continue to consume essential goods and services. Understanding this difference helps you avoid overexposure to risky areas during uncertain times. Interest rates play a powerful role in business cycles. When interest rates are low, borrowing becomes cheaper. Companies expand, consumers spend more, and asset prices rise. When rates increase, loans become expensive, spending slows, and businesses face pressure. Many beginners ignore interest rate cycles completely. The minority pays attention to monetary policy not to predict markets, but to understand the environment in which companies operate. Another important aspect is investor psychology during cycles. During booms, optimism creates overconfidence. People believe risk no longer exists. During busts, fear creates pessimism. People believe markets will never recover. Both extremes are dangerous. The minority learns to stay emotionally balanced. They avoid aggressive buying during euphoric phases and avoid panic selling during fearful periods. This emotional stability is one of the biggest advantages you can develop. Business cycles also affect company valuations. During optimistic phases, investors are willing to pay higher prices for future growth. During pessimistic phases, even good companies can be undervalued. This creates opportunities for long-term investors who are patient and disciplined. The minority waits for moments when fear creates attractive prices and avoids chasing overpriced assets during hype-driven phases. It is important to understand that cycles do not follow fixed timelines. They are influenced by global events, policies, technological changes, and human behavior. Trying to time cycles perfectly is extremely difficult. Instead of predicting exact turning points, focus on awareness. Ask yourself, are we in a phase of extreme optimism or widespread fear? Are businesses benefiting from temporary tailwinds or facing structural challenges? This awareness improves decision quality without relying on prediction. Another mistake beginners make is blaming companies for cycle-driven problems. When profits fall during economic slowdowns, people assume management has failed. Sometimes this is true, but often it is simply the environment changing. The minority looks deeper. They analyze whether the company is adapting, controlling costs, protecting cash flow, and maintaining long-term competitiveness. This perspective helps separate temporary challenges from permanent damage. Here is a simple exercise. Pick a company you follow. Look at its performance over the last 10 years. Observe how revenue, profit, and stock price behave during different economic phases. Notice patterns. You will begin to see how cycles influence outcomes. This practice trains your mind to think long-term and reduces emotional reactions to short-term news. Understanding business cycles also improves risk management. During uncertain periods, reducing exposure, increasing diversification, and maintaining cash reserves can protect capital. During recovery phases, gradually increasing exposure can improve returns. The minority treats capital protection as a priority and adapts behavior to changing conditions rather than acting impulsively. Most importantly, cycle awareness builds patience. When you understand that downturns are part of the process, you stop panicking. When you understand that booms are temporary, you stop becoming greedy. This balanced mindset is rare, but it is powerful. It allows you to stay consistent when others are emotional. Remember, businesses do not operate in isolation. They move with economic rhythms that repeat over time. If you want to think like the minority, stop focusing only on daily price movement and start observing the bigger picture. When you align your decisions with long-term cycles instead of short-term noise, you build resilience, clarity, and long-term advantage. As you continue this journey with the minority market, keep training your awareness. Cycles will come and go. Your mindset and discipline should remain stable. This stability is what separates consistent performers from emotional participants.